This is your Mortgage Rate Watch for Monday, January the 10th, and I'm Keith Akada with the Mortgage Reel. So a question that we receive on a daily basis is, are interest rates going to move any lower? So let's try to break this down. One thing that we can agree on right now is the economy is improving. Whether you believe it in the unemployment reports or you believe it in the stock market, regardless of where it is, overall, the signs are, and economists agree, that we're showing signs of improvement. Here are some key things to point out. Right now, for the housing sector, the one thing that we have to pay attention to is consumer confidence. As people begin to feel that their jobs are more secure and jobs are being created, which as of last Friday we saw that jobs are being created, when people get into these jobs, they start feeling more certain about the future and they start to buy. Now, when they start to buy, what's on the flip side, this is great for homeowners, equity and appreciation, but on the flip side of that, we do have to pay attention to the rates because interest rates will rise. On the other side of that, we have to pay attention to what's going on overseas. We continually talk about the European markets and what's going on with the euro as they still really have not come out to say how deep and how bad their problems are. As that does come out, it's going to turn the U.S. bond market again into that safe haven, and then those funds are going to come into the U.S. stock market. But here's the key thing to remember with that. Those funds that come into the United States bond market from the European and overseas when investors look for that safe haven, it's all short term because the minute it turns around, it's going back overseas. What we really do have to pay attention to is what's going on with fourth quarter earnings here. As of right now, there's a lot of optimism with what's going on with fourth quarter earnings. Overall, the economy improved in the last half of last year, and it is going to show that there is room for growth. But the stock market, as all the economists and analysts have been saying, is ripe for a pullback. And what they mean by that is there could be a huge profit taking that does start to happen. When profit taking happens, investors start to sell off their positions. That money does come into the bond market as a safe haven again inside the United States markets. So here's all the factors that really have to pay attention to. The European market, economic reports, treasury auctions, which we're going to have a ton of this week, global inflation, rate hikes, QE2, stocks, and fourth quarter corporate earnings. All depending on how this cocktail mix again does come out and play out, it could show that we could see interest rate pressure lower. A lot of people ask again, and we're going to conclude it with this, is how much lower can interest rates go? Well, here at the Mortgage World, we're going to take the stance of about 4.375 depending on where you're at without saying APR and the cost of loans. But that's about where we could see the national average move close to, maybe about a 4.4 as a national, 4.5. But going below that point, if you look at today's bond market chart, it's going to be really difficult for it to pressure lower. If you go back, this is just a 1/4 snapshot of the market. If you look at where we were from the far left as of 3 months ago to where we are today on the far right, you can see in order for interest rates to go back below that 4% level, we have a steep ways to climb. And keep in mind that 3 months ago, the optimism was not there about the economic return and it's getting better. Overall, the notion was we're not sure. Now here we are 3 months later, media has totally changed, the drunk monkey's been trained, and everyone's saying that everything about the economy is getting better. If you look at that pattern of where interest rates need to go in order to drop lower, can you really make a statement today, anyone out there, to say interest rates are going to go back to where they were 3 months ago? It's very difficult to even get there because with economic improvement, with what's going on with the stock market, the jobs market, it really has no reason to come back down. The other key thing that we didn't have 3 months ago was quantitative easing 2. Quantitative easing 2 was $600 billion being put into the economy. Definitely fears of inflation. Anytime you hear inflation, that's the arch enemy for bonds, for homeowners and future homeowners. When you hear inflation, that's bad for interest rates. So for the possibilities of it going back down to where we were, it's a steep climb. There's going to have to be a ton of bad economic data to come out. Stock market's going to have to take a huge crash, and everything is going to have to go negative again. Unless that sign does come, we really do not feel that it's going to be a turning point. So make sure to follow us on our Facebook fan page. Leave any comments below if you found today's post interesting or if you found it helpful about locking or not locking your loan in. And again, on our Facebook page, we'll be posting more information there for any breaking news, also on Twitter. Other than that, we'll be back tomorrow with more news. Thanks. I'll talk to you soon.